In this video guide, we are going to discuss not only what a share of a stock is, but the different types of shares that are available, including the difference between authorized and outstanding shares. Understanding these definitions is a key aspect of investing in the stock market. So the definition of a share is a unit that represents ownership in the issuing company. So when you buy a share on the open stock market, you're theoretically purchasing a portion of that company. However, ownership of shares does not mean true ownership. And to elaborate, share owners are not necessarily entitled to profits and don't have a say in day-to-day operations or activities. You can't direct new hires. You can't, take an equal percentage of the profits of the company based on the shares you own. Instead, you're, one step removed from this ownership area. And what I mean by that is that shareholders may receive a dividend, but the amount of the dividend that you receive, which a dividend is a payment from the company that's issued to stockholders, the dividend is determined by the company, and many companies don't have dividends at all. And the reason that companies don't pay out their full profits into the form of a dividend, or they might not pay a dividend at all, is because companies also want to spend money on activities that allow the business to grow, like hiring new employees or getting new manufacturing facilities, getting new service contracts, buying smaller companies. So it's not always in the shareholders' best interest to take profits in the form of a dividend. And as a result, the company itself decides when to issue a dividend and if at all. And shareholders, while they don't get to, act in the day-to-day operations of the company, many corporations allow shareholders to vote on, key issues every year. And many companies also allow shareholders to elect the board of directors. And depending on how much stock is owned by the public, it really depends on how much power the board of directors has. In a company that's largely public, the board of directors can do everything from, hire or fire the CEO to, replace all executive staff. Whereas in other companies that are largely held by the founders or, the family that started the business, then that board of directors might not have much strength. So shareholders are that's their biggest source of power, is electing the board of directors. So to talk about shares themselves, there's something known as authorized shares. And what a lot of investors don't realize is that when a company, incorporates and goes public, the amount of shares it issues is declared in its articles of incorporation. And that is the total number of shares the company may issue at a time. And the reason this is important is because most companies actually only issue a small portion of their total authorized shares. And what this does is if the company owns most of the authorized shares of the stock, that means shareholders really don't have any rights, which sometimes is a good thing because there's a lot of so-called activist investors that may try to, make the company do things for short-term gain that might not be in the best interest of the company. And an example of that is consider Apple with Carl Icahn. He is always trying to get Apple to buy back its own stock. And because he's only able to own a small amount of the company, he really can't force Apple to do anything. It also allows the company to resist what's known as a hostile takeover. And that is when, an outside party buys the majority holdings of the stock and uses that to gain control of the company. So if a company wants to buy another company and the company that's being recruited to be bought doesn't want to be bought, it could be what's called a hostile takeover, where another company just buys all their stock and they take over by default. So only issuing a small amount of shares from the authorized pool allows the company to retain ownership. It also allows the company to hold what's called a secondary offering, and that is when the total number of shares is increased as the company sells some of its previously authorized shares. And this is, theoretically good for the company because the company might want to raise, some money during its small growth phase, but it doesn't want to sell the whole company just yet. And then as it grows in value, it can sell more shares to raise more funding down the road. that, if it theoretically is increased in value many times, that secondary offering is going to bring in a lot of money without adding too much stock to the pool. And as we're going to discuss in the next slide, secondary offerings don't always work out in the favor of the investor. We also, to take a step back and finish up here, authorized shares having extra authorized shares allows companies to award stock options to employees, which basically allows the company to sell stock to the employees at, its current price sometime in the future. So if the company grows in value, employees can buy these discounted shares from the treasury, from these authorized share accounts, and then sell them on the open market. So what you're probably more familiar with is outstanding shares, and this is the total number of shares that's already been issued from the authorized pool. So what this means is if a company has 5 million shares authorized, it might only sell 1 million in its initial public offer, and those 1 million shares are going to be the authorized shares. Not the authorized, I'm sorry, they're going to be the outstanding shares. The 1 million shares that have been sold or given to employees will be the outstanding shares. And this includes two things, the float and restricted shares. The float refers to the number of shares on the open market. So all the shares outstanding might not necessarily be open for sale. And the reason that some of the float is not all of the outstanding shares is because there's something known as restricted shares. And restricted shares are shares that are issued but can't be sold yet due to SEC guidelines. And an example of that is when a company goes public, and let's say Facebook, for example, they had however many shares outstanding, let's say 1 billion, I'm not sure to the exact number. I think it might be like 500 million or so. Well, the founder, Mark Zuckerberg, had about 100 million or so of those shares, and various employees that have been with the company for a long time that have received shares as part of their compensation packages, along with early investors, they all had portions of the total number of outstanding shares as part of the agreement with the company, as either rewards or because they founded it or they were early involved. And the result is that these shares can't be sold right away because the SEC doesn't want companies going public and having the founders sell all their shares, and the company's not really worth that much. So they put a restriction where shares can't be sold for a certain amount of time. So these shares are used as part of the outstanding share count, even if they can't be sold on the open market. And outstanding shares is important because it's used for calculating metrics such as market cap and earnings per share. And this is where the secondary offering can hurt the investor, is that a company might have 5 billion authorized shares, but only sell 1 billion of them, or give those to employees or the founders or whatever. So that means only really 20% of the authorized shares are on the public market. Well, if the company holds what's called a secondary offering, where they sell some more of those authorized shares, those shares go out into the outstanding share count and are still used for the market cap and earnings per share calculations. So if a company had 5 billion authorized shares but only sold 1 billion authorized shares, held a secondary offering where it sold another 1 billion shares, all of a sudden everyone's shares are suddenly worth half as much as they used to be. Now, the drop won't be so significant because the company is going to get money for those shares that it sells, so that will, prevent the stock from dropping by half, but at the same time, your one share represents half as much of the company as it used to. So that can really hurt an investor, but sometimes secondary offerings can help the investor, and that is when the secondary offering makes sense. And an example for that is Tesla recently, had a secondary offering after it, went tripled up in price. And the reason this actually drove the stock higher is because Tesla was saying, hey, our stock's gone up a lot. We need to sell some more stock. This is going to allow us to really expand our manufacturing capacity. We're going to be able to grow many times faster and produce a lot more vehicles. So if they're saying, well, yeah, we're going to increase the total stock volume by 20%, but we're going to grow our manufacturing capacity by 100%, we're going to be able to grow 5 times faster or we're going to be able to go twice as fast, but only dilute the pool by 20%. That actually makes the stock go up. But when a company needs to raise money because it's just running out of money, that's where dilution occurs, and that's where the share price can really be hurt. So it's just good to know that at any time a company can hold a secondary offering and dilute your holdings. And you can see how much of the authorized stock is available if you look, into the investor relations materials provided by various companies. And at the same time, though, the opposite of dilution can occur if a company issues a buyback. And what that means is a company will buy back some of its own outstanding shares and just put those back in the authorized share pool. And this will decrease the total number of shares, so as long as the company is worth the same amount of money, the earnings per share is going up and the market cap is staying the same. But if there's less shares, market cap is share count times price per share. If market cap stays the same and shares go down, then price per share has to go up. But buybacks only work if they're large, because a lot of companies, they announce a buyback, but it's only like 1% of the company, and then they proceed to give that 1% back in the form of stock options. So it's kind of a false buyback. So if this video was helpful for you, subscribe for more stock videos. That's about it for shares. Just keep that in mind, that there's a difference between float and restricted shares. You can easily find information on a new IPO, when restricted shares are available for sale. Just do some Googling and it's not too difficult to find. But it's good information to have.